So this one's from Vishal. What are the pros and cons of buying shares versus buying puts on the shares?
Okay, great question. Great question for a whole number of reasons. So, uh, first of all, just a small nuance here is that what you mean probably is selling puts. So buying puts would give you protection and it would allow you to sell your shares to someone else if there was a decline. But selling puts is where somebody will put them to you. So there are several benefits and they do get quite subtle, but the obvious benefit, and I should point out, this is not the way that these products are used typically. Okay, if you went around, first of all, not many people are using these products, not many funds are using these products, but those that are not using them in this nature. They're using them either as a form of protection, or they have some complex trading strategy. They're typically used very short term. The prices are extremely volatile, but it is incredibly rare to use the sale of a put as a tool to deliver the equity. And, as Peter Kaufman says, where there's mystery, there's margin, and there's just not a lot of people operating in this way. And so you end up with a lot of mispricings because people are doing different things with them. The major benefit is that, just like the slide at the beginning, the Berkshire example, or any other example you'd look at, when you want to buy the stock, you can either go to the New York Stock Exchange and buy it, or you can sell a put through the Chicago Board of Exchange. And when you do that, you pick up a premium and it reduces the price that you're paying for the security initially. And when you reduce that price, it actually increases your return substantially over the long term. So in the example where you had a $100 price stock, by the way, if it was 100 for a number of years, a put premium might be $1 or $2. But the fact that it went from 200 to 100 means that you can now get 25. And so somebody's willing to pay you 25. You've now reduced your investment, the denominator of your investment, to $75 from 100. And so if you ultimately sell at 150, instead of making 50% by going from 100 to 150, you now make 100% because you've gone from 75, your reduced price, to 150. And so at the highest, most important and obvious level, you're just getting a discount to the price, to the retail stock exchange price. On a more subtle one of the more subtle advantages is the sort of psychological advantage. So people talk all the time about how they're trying to, look, this group needs to know, I mean, you can't time the market, okay? If you try to sell at the top and buy at the bottom, it just doesn't work. We're all human beings. We all suffer from the same biases, and worse, even if you do top tick the market, and I mean, it's very hard to get back in at the right time. And then as soon as the market starts rising again, I mean, many of you probably had experiences with this, and probably some of you did a great job, but back in March, as markets started rising again, if you ended up in cash because you sold out intelligently, it became very hard to put that back in because you always want yesterday's prices. You don't want to overpay and price on the rise. So by selling these puts, what it actually does is it sort of enforces a very rational mindset where you sit back, do your calculations, understand the value of the business, determine the price that you want to buy it, set your limit orders, you sell that product to the counterpart, and you're in and you're invested. And so if it's a little off the bottom, you get a premium, so it brings you back down. So there's these psychological advantages I find that maybe don't force you to focus so much on an absolute bottom tick of some security price or top tick of some security price. And by the way, if any of you are interested in doing this, I recommend just go out, each put is 100 shares, and go out and take your personal account and go out 1 year and write one on some security you like to own and watch it play out, because you will just learn a lot from that experience.
Okay, we've gotten a few more questions about puts, so I'm going to actually just put them together. So first of all, do you sell on the money put contracts? why or why not? And secondly, what new companies are you considering to be buying or selling puts at?
Okay, very great question. Uh, so you can sell puts. I know there's a wide range of people here. So basically, when you're selling a put, you determine the price that you're going to buy the stock, and you could choose a price that's above the current market price. You could choose it at the current market price, which is called at the money, or you could choose to buy the shares below the current market price, which is out of the money. And in many cases, so it sort of depends on how big your cash pile is and how much you're trying to put to work. Oftentimes, we create a matrix where we'll sell above the money, at the money, and below the money contracts at different strikes. We'll sell them also expiring at different dates. So what oftentimes happens is we buy some of them and we don't buy others. And actually, the ultimate outcome, because we'll pick up premiums on some that we didn't buy and others that we did, if you sort of look at it from that perspective, it just brings the price way, way down. But it really comes down, the most important thing to be thinking about is, what am I willing to pay for this security? What's the value? What's it selling for? And at that point, you can write a contract. So if you're saying to yourself, for example, I would love to buy, name a company, I would love to buy Disney, but I would only pay $100 for it. So I'm going to wait for the next 6 months with a whole bunch of cash. And I'm only going to buy it if it goes to 100. That's an exceptional opportunity to go out and sell a put to somebody. You sell a put for 100, they pay you $10. Now you're going to buy it for 90. The price today is 130. If it happens to go down to 100, which is when you wanted to buy it, they'll force it to you. By the way, if you didn't sell the put and it dropped to 100, you might get greedy and say, oh, now I'll wait till 90. And then you miss the opportunity that you were waiting for, which is why you don't want to be timing markets. So we will sell above, at, and below, oftentimes on the same securities. So the next question is, what are we looking at? So first of all, we're always looking at a lot of things. We're always looking for new ideas. And we have a number of channels that we're reviewing always to find those. But keep in mind, we don't need very many new ideas at all. I mean, we have a fully invested portfolio. There's not any pressing need to go out and find a new company to invest in. But there are a lot of, I think, great opportunities out there, and some of them are beaten down. There's two. I bucket things in two categories. There's sort of the Graham investments that we look at, and those are, many of you might have heard the idea of the cigar butt company. Basically, those would be companies that are not really growing. They're sort of trading at a discount to their intrinsic value, and you get them at a big discount. So you buy them at 50%, maybe you get a pop, and then you sell that, and then you move on to the next one. And then there's the Phil Fisher companies out there. And Phil Fisher is more of the long-term compounding firms where you still can buy them at a discount, but they just keep growing and growing and growing. And there's all sorts of reasons, from tax advantages to avoiding mistakes, that Fisher type companies are greatly preferred. So, we're looking for Fisher type companies. If you're thinking about Fisher type companies, you get to think much longer term, in my view. You go through the crisis. And so, if you're asking because you want to look yourself, you might start looking in some of the beaten down industries. I mean, there's all sorts of really beaten down sectors, from travel sectors and entertainment sectors. There's financials are beaten down. I mean, things are really have been hit hard. And so you can find a lot of great stuff in that area. But for us personally, we're not really, we've added kind of one company. You'll probably see it in the the audit and things at the end of the year. But other than that, we're not really adding anything at the moment. We're compounding our capital. Our capital is just, it's going to compound.
This one question says, upside is limited to the premium collected when you sell the put contract. So the question is really, how do you hedge the upside if the stock runs up? And would you maybe buy a call option to lock in a further gain?
Yeah, that's a great question. And we do that. So it just gets a little, I think, beyond the scope of like a mass group discussion sometimes. But yes, there's been a number of times where we will use, in fact, we have calls on Berkshire Hathaway that go out 2 years with a strike of $170. And so we will use put premiums to buy the call. So it actually becomes like a free option. So first of all, I will also add, I much prefer money coming in. Okay, there tends to be a systematic advantage to selling both calls and puts. They tend to be slightly overpriced, so I prefer to sell them rather than to buy them. However, if there is a time when I'm looking at buying a call, we would use, I tend to use deep in the money calls that are very long dated and basically just give us an opportunity to buy that security out a couple of years. And when the risk reward dynamics are such or volatility is extremely high, we can just use put premium to buy that call. And it's a pretty nice little system. So we do that. We do that. Not all the time, by the way, but typically we're selling puts, by the way, since 2005, as long as there are contracts available on the security and the IRR is sufficient. I wouldn't buy stock in any other way. I wouldn't buy it outside the portfolio in any other way. Why would you not even if you really wanted it and things were so volatile, you just sell it in the money going out a week and you still get it for below the price on the stock exchange, which is such a huge advantage. So I always use this put selling. Every once in a while, there will be maybe a very conservative company where we just want to own a call as it looks like it's going to run up a lot, and we might use it strategically.
So related, have you thought of using deep in the money call options to control the long positions? The questioner's saying that there's a very cheap implied interest rate, and you could get the added benefit of loss harvesting if the market tanks.
That is an interesting question. Added benefit of loss harvesting, meaning that people are going to sell when the market tanks and probably take their short-term capital loss. I'd be happy to talk to whoever it is. Maybe they can clarify a little bit or let me know, but outside of this call. So we haven't considered that exact strategy. And by the way, you can go pick up books on option strategies. There are going to be thousands or whatever of different permutations of ways you can combine these. We're actually using them for the most simple, in my view, the most simple and straightforward way. We are just reducing the price of entry. And the more complex you get, I think the more you run the risk of finding yourself. Part of the problem with options is there's always this time horizon. And if things are totally irrational in the marketplace, and your time runs out, you end up in a situation where you're either buying or not. So when you own calls, you always run the risk that at that point, when the call expires, the market's just tanked. So you lose your whole premium. So we haven't really considered that exact strategy. I understand that interest rates are very low, which adds a considerable amount to that and reduces the overall price, but there's also high volatility. Anyway, I'd be happy to, maybe that's an offline sort of conversation that's had.